You're listening to The Credit Edge. What could go wrong? And are you compensated for that risk? That's the question we explore through credit markets, cycles, and portfolio construction.
Welcome to the deep dive. And thank you sincerely for sharing this material with us. It's quite something, not just another set of financial ideas.
No, it really feels like a fundamental re-engineering, doesn't it? How we think about money, yes, but also time, and maybe what wealth actually means.
Exactly. It just cuts through all the surface level stuff, straight to the core mechanics.
Agreed. And I think our mission today really is to take that deep second level look to analyze what most of us just accept about building wealth.
We're definitely moving past the standard how-to guides, how to save this, invest that.
Right. We're asking why. Why these beliefs? And crucially, who benefits when we follow them? The aim here is to pull back the curtain on this huge, often invisible trade we make every day.
And that core idea, the really provocative one that caught my attention immediately, is this. You think you're just investing money, capital, but what you're really putting on the line, what you're trading away control of is, well, it's your time, your life, the only resource you truly can't get back.
That's it. That's the hidden trade. And we really need to nail that down right from the start as our framework. Every dollar earned, every single one that lands in your bank account.
It represents actual hours, doesn't it? Hours you worked, hours you spent, hours gone forever.
Concrete hours of your life.
Yeah.
Committed, spent, never recoverable. This isn't just finance theory. It feels much more fundamental. It's about life, years, time on this earth.
So the big question weaving through this whole discussion then becomes, okay, which side of that deal are you actually on, fundamentally?
Right. And maybe more importantly, what do you need to do to shift that balance, to genuinely get back what the source calls time autonomy?
Because the standard advice, the path most people are on, it doesn't seem to lead there very often.
Rarely. Precisely. So let's start at the foundation. Let's look at money through this lens. Money as stored labor.
Okay, let's unpack that starting point. The source jumps right in with Benjamin Franklin and that famous line, remember that time is money. In today's world, it feels almost like a cliche, right? Like simple productivity advice, don't waste time, work harder, maximize your hourly rate.
And that common take, that surface reading, it's so incredibly shallow. It completely misses the really profound economic point Franklin was making.
Correct.
If you actually go back and read his writings on it, especially advice to a young tradesman, he wasn't just philosophizing. He wasn't just saying, be productive. He was laying out a pretty rigorous economic calculation, an opportunity cost.
Right. Can you detail that full explanation? Because that seems to be the mechanism that turns it from a tired phrase into, well, a critical insight.
Absolutely. Franklin wasn't just saying, get busy. He was spelling out the direct quantifiable link between human effort and currency.
Yeah.
He wrote, essentially, if you're a skilled tradesman and your labor can earn you, let's say, 10 shillings a day,
Okay.
and you decide to sit idle for half that day, maybe go to the tavern or just relax,
Yep.
you haven't just lost 6 hours of potential work time. You have demonstrably, concretely thrown away 5 shillings, the money you could have earned.
Ah, I see. So the cost of being idle isn't just the lost time itself or the momentary pleasure of not working. It's the actual measurable monetary value of the work, the labor potential you didn't deploy in that period.
Exactly that. The cost is concrete. It's the money you failed to generate because you didn't apply your labor.
Yeah.
And that's why his statement is so fundamental for finance, for this discussion. It frames money not just as some abstract medium of exchange,
But as captured labor, stored potential waiting to be used.
Precisely. Captured labor potential, stored up, ready to be deployed.
Okay, let's bring this forward. How does this Franklin insight map onto the modern way most of us work? The paycheck, the salary, the 9-to-5 structure?
It's a direct one-to-one translation. It's unavoidable, really. Right. When you commit your 40 hours a week or your 2,000 hours a year to an employer, you are trading that finite block of time, your physical presence, your mental energy, your focus, your actual life force, really for a paycheck.
So the paycheck itself, it's just my time, my irreplaceable time, converted into something else, something more liquid, more transferable.
That's exactly it. You're selling a finite resource, your time, for a specific monetary price. The paycheck is your time, monetized.
Which means money, then, by this definition. It's fundamentally transferable time. It's not just a claim on goods and services. It's a claim on other people's time.
Correct. We absolutely have to see money as stored labor. Or maybe even better, time made transferable and exchangeable.
Okay.
That's what allows this whole complex economic network to function. Time spent in one job, one profession, can be swapped for time spent in a totally different field, maybe thousands of miles away.
Let's use the Source's grocery store example to make this really concrete, because that really shifts it from an abstract idea to something.
It's visceral.
Yes, that's a powerful illustration. Think about that moment you're at the checkout, paying for your weekly groceries.
Okay.
You're not just handing over currency for, apples and bread. In that instant, you are exchanging the labor hours you stored up at your job.
Right, my hours writing code or teaching or whatever it is.
With the stored labor hours from the entire chain of people who got that food onto the shelf.
So my time is being traded for the farmer's time planting the seeds, the person driving the truck's time, the refinery worker's time making the fuel, the grocery clerk's time stacking the cans. It's this huge interconnected web of traded time.
An intricate, decentralized web of traded time commitments.
Exactly. And realizing this, it helps explain why, even though modern economics has evolved way beyond it, we should probably acknowledge the foundation laid by classical thinkers. People like Adam Smith, David Ricardo, later Karl Marx.
Right, they all developed versions of the labor theory of value.
They did. The idea that the inherent value of something is basically tied to the amount of labor time needed to produce it.
Now, that theory has its issues in today's economy, right?
Mm-hmm.
It struggles with services or intellectual property, scarcity value.
Oh, absolutely. It has profound limitations in explaining market prices and value in our complex, capital-intensive, tech-driven world. But the core insight remains incredibly powerful for our framework here.
That the money you hold fundamentally represents stored human effort, stored time. It forces you to view the entire financial system as essentially a mechanism for allocating and distributing finite human time.
Okay. This brings us to that really pointed question the source material raises, the one that first-level thinking just seems to glide right over. And yeah, this feels like a moment where we need to pause and really let it sink in.
This is what the author calls the critical, almost existential $100,000 portfolio question.
Right. So you look at a significant chunk of money you've managed to invest. Let's use that $100,000 figure. The question isn't just how much has it grown or what's the return?
No, the real question, the second level question is, how many years of your actual life, how many 40-hour work weeks, how many commutes, how many missed family dinners or personal projects did you trade away just to accumulate that number?
Wow, that forces a possibly painful shift in perspective.
It does. You stop seeing that investment as just a cold number on a screen that your advisor talks about. You start seeing it as a tangible piece of your life force. Hard won. That money is time you spent away from other things, from living, essentially.
And the potential consequence, especially if you follow the standard consensus path to building wealth, it's quite severe, isn't it? If that money only grows at the average market rate, slowly compounding.
The question becomes, will you have enough healthy, productive, enjoyable years left to actually use the results of all that traded time when the compounding finally pays off?
Time is the ultimate non-negotiable. That's the constraint.
It is. We can always figure out ways maybe to earn more money, but we absolutely cannot earn more time. And standard financial advice often pushes this ultra long-term view, 30, 40 years, rely on compounding, which kind of ignores how precious time itself becomes, especially later in life.
Okay, but let me push back here a bit, play devil's advocate. Isn't the whole point of that consensus investing approach save diligently, invest in broad markets, let it compound? Isn't the goal precisely to create more free time eventually? The narrative is, you do this, you sacrifice now, and eventually you hit retirement, which literally means freedom from having to work.
That is the first level conclusion, yes. And look, in a perfect world with smooth, uninterrupted 40-year market cycles, it might even be theoretically correct. It could work out.
But
this is exactly where we need to pivot to understanding the lender versus debtor dynamic.
Yeah.
Because relying solely on simple appreciation, just watching that portfolio number tick up, maybe 7% a year on average, that's often the slowest, most passive route to actual time autonomy.
why the slowest? What makes it slow?
Well, for one, it leaves you completely exposed to market volatility. A big crash can wipe out years of progress in weeks, forcing you to stay in the work system longer just to get back to even. And second, it keeps you dependent on external factors, market whims, economic cycles, interest rates for decades. Your eventual time freedom is postponed, conditional, and uncertain. The faster path to time autonomy, the one we need to explore, involves generating cash flow now. Cash flow can function independently of market appreciation and potentially pull you out of the time for money trade much sooner.
So the goal isn't just aiming for the biggest possible number way off in the future. It's about finding the strategy for the fastest acquisition of autonomy. And that means we have to challenge the standard playbook itself.
Precisely. We need to apply second-level thinking to that consensus. Right. So if the goal is accelerating that acquisition of time autonomy, we have to take the standard playbook, those core beliefs that guide most investors, and really subject them to some rigorous second-level thinking.
We need to stop just accepting the common wisdom and start asking, well, why is this the common wisdom? What are the underlying mechanics and incentives?
It's exactly. Let's first clearly define those consensus beliefs. The source material lays out 5 key points that are pretty much accepted as gospel by the majority of retail investors. These are the first-level conclusions you get from headlines or basic finance books.
Okay, lay them out.
Belief number 1, the big one. Stocks outperform bonds over the long run. Decades, even a century of historical data back this up. So the default place for your stored labor is the stock market.
Makes sense based on history. Okay, second.
Second, diversification across lots of different stocks reduces risk. This is the bedrock of modern portfolio theory. Don't put all your eggs in one basket, spread it out.
Standard advice. Third.
Third, financial advisors, wealth managers. They exist primarily to help you get better returns. They're the professionals, right? They have specialized knowledge to navigate the markets better than you could on your own.
Okay, seems logical. Fourth.
Fourth, debt is bad. Debt is something you need to avoid or get rid of as quickly as possible.
Very common advice. And fifth.
And fifth, building wealth fundamentally means accumulating net worth. The bigger your portfolio number, assets minus liabilities, the richer you are. That's the scoreboard.
Okay. And the source is careful to say these beliefs aren't necessarily wrong, are they? But they are incomplete.
That's the crucial distinction. Incomplete. They work on a surface level, they describe historical averages or offer basic safety rules, but they obscure the deeper systemic consequences.
They don't explain the why behind the system.
Exactly. They're descriptive, not analytical. Second-level thinking pushes past that surface observation and starts asking systematically, okay, who benefits when these are the rules everyone follows?
Let's unpack those critical questions then, the ones that force that shift from just observing what happens to understanding the who benefits and why.
The absolute first question to ask is, who benefits when you, the individual retail investor, deeply believe these 5 things and follow that script perfectly?
Well, if millions of small investors are consistently told to put their savings into stocks and index funds month after month for 40 years, who is on the other side of that? Who's creating and selling those stocks? Who's managing those funds?
Right. Who profits from the sheer volume of capital flowing in, the predictability of it, the management fees charged on it, regardless of whether your individual 40-year plan actually works out perfectly?
It's the institutional side, isn't it? The banks, the brokerage firms, the asset managers, they get paid for facilitating the flow, whether the market goes up, down, or sideways, as long as people keep putting money in.
Their business model thrives on that steady inflow driven by the consensus. Okay, second critical question. What are the institutions themselves doing? The big players, pension funds, university endowments, sophisticated family offices, the people Howard Marks or Seth Klarman might advise.
Are they just buying and holding the same S&P 500 index funds that retail investors are told to buy?
Or are they engaged in fundamentally different strategies, often involving complex debt arrangements, direct ownership of assets, private equity, things far removed from simple passive indexing? The evidence suggests the latter.
Okay. Third question, focusing on incentives. Why does the financial system predominantly promote and reward this specific behavior, save consistently, invest passively for appreciation over decades, rather than, say, actively generating cash flow or becoming a lender?
Well, think about what the system needs to function smoothly. It needs stable, predictable, long-term capital. Passive buy and hold investing provides exactly that. It keeps capital locked up, feeding corporations and the financial services industry.
Whereas active cash flow generation, like being a private lender or buying rental properties directly, that's more complex, less predictable for the big system.
It introduces variability. It potentially keeps capital outside the main fee-generating channels of Wall Street. So the incentives naturally align towards promoting the simpler passive approach for the masses.
And the final challenging question. If literally everyone believes stocks outperform long-term and that consensus is almost universal, is following that belief still an edge for an individual?
Or has the edge been completely competed away, priced in, precisely because everyone believes it and acts on it?
If the vast majority of capital is chasing the same historical average return,
then the potential for achieving above-average results, especially in terms of accelerating time autonomy, basically vanishes. The consensus keeps everyone clustered around the average, which, again, benefits the system by ensuring stability and predictable flows for the intermediaries.
okay, let's zero in on that debt belief, because I think that's where a lot of the tension lies for people. Avoid debt. Isn't that just fundamentally sound advice? Isn't telling people, especially those who might struggle financially, to avoid debt crucial for preventing them from getting into serious trouble, even ruin?
That's an absolutely critical point, and we have to approach it with real nuance. For someone with, say, unstable income, maybe limited financial literacy, or just no emergency savings, yes, avoiding high-interest consumer debt is objectively good, necessary advice.
It's a safety mechanism.
It is.
Right.
It prevents them from essentially pre-selling more of their future time than they can realistically deliver. It promotes stability in their lives. Absolutely vital.
So avoiding debt is good for individual financial survival.
Yes. But, and this is the crucial second-level insight, avoiding debt keeps you safe, but it also keeps you firmly anchored in the debtor class.
Explain that. What does that mean functionally?
It means you're perpetually on the side of owing time rather than owning time claims. Now, contrast that with the institutional side. The sophisticated players, the Warren Buffetts, the Charlie Mungers, the private equity giants, do they avoid debt?
Generally, no. They use it strategically, right? Leverage.
They rarely avoid debt entirely. In fact, they actively own credit. They are the ones issuing loans, structuring debt deals, or using borrowed money leverage to acquire income-producing assets on a massive scale. They understand that debt when used correctly.
Meaning collateralized properly and aimed at generating cash flow.
Exactly. When used that way, debt isn't seen as just a dangerous liability to be shunned. It's viewed as a powerful tool for scaling the acquisition of time, their own time.
So they use debt to control assets that demand less of their personal stored labor, while the average person is taught to fear debt because it consumes their future stored labor.
Precisely stated. And think about the systemic effect. Teaching the masses to avoid debt ensures the system has a constant, reliable supply of workers. Workers who are relatively stable, yes, not taking huge risks, but who remain consistently dependent on the system.
Because they still need to work to pay for the essentials, housing, transportation, education, things that for most people require taking on debt anyway, like mortgages or student loans.
Right. Following the consensus advice keeps you a stable worker and often a safe debtor, like a mortgage holder. It keeps you within predictable bounds. It discourages you from trying to switch roles from debtor to creditor, which is the real path to autonomy.
So this divide, the lender-creditor versus debtor divide, it's not just some abstract accounting category. It's the fundamental fault line determining who controls whose future time.
The debtor sells their future time. The lender collects claims on others' future time.
That is the absolute core of this time autonomy framework. The two classes are defined entirely by the direction that future time commitments flow. You either promise your future work to others through debt,
or you accumulate promises of future work from others through owning credit instruments or cash-flowing assets bought with leverage.
The implications are huge. The weight of that distinction is immense. It really demands that we look very closely, almost surgically, at the exact mechanism of the trade for each of these two classes.
Okay, let's start with the debtor's side of the transaction, the mechanism of trading away future time.
Right. So the debtor is effectively what? Pre-selling their future labor. Trading time they haven't lived yet for something they want or need now.
That's a very accurate way to put it. They trade their future time commitment for immediate, present access. Access to goods like a car, services like education, or capital itself, like a mortgage for a house.
Let's use that mortgage example because it's so common, and when you frame it this way, so profound. A standard 30-year mortgage.
Okay, so an individual borrows, let's say, $300,000 to buy a home. On the surface, it's a financial contract, but underneath, using our framework,
they're committing, 30 years of their future work, their future life energy?
30 years of their most productive future labor potential.
Yeah.
Their energy, their focus, their daily grind. Committed, promised to that lending institution.
When you put it in terms of time, that's a staggering commitment. Every single mortgage payment, month after month, for 3 decades. It's not just money leaving an account.
No. Each payment represents a measurable, finite slice of your future life force that you already promised away. It's gone before you've even lived it, in a sense.
That is the unfiltered reality, isn't it? Years, potentially decades of the debtor's life are, as the source says, mortgaged to obligations.
And the consequence is a loss of choice, a loss of autonomy. The debtor has to keep working, has to maintain that income stream because they've already spent their future time. Their freedom of movement, their ability to change course is severely restricted.
And this isn't just mortgages, right? Student loans are a huge one, committing future time to pay for education you received years ago.
Absolutely. Credit card debt is perhaps even more direct, committing future labor to pay for consumer goods or experiences that might be long gone, used up, forgotten. It's all an advance payment drawn against labor you haven't performed yet.
And the core mechanism that makes this stick, that enforces the commitment, is collateralization.
Exactly. When the debt is secured, backed by the house itself, or the car title, or even, in some cases, a claim on future wages, the lender's risk goes way down. And the debtor's commitment of future time becomes much more concrete, much harder to escape.
Because if you fail to deliver the promised labor, if you stop making payments the collateral, the thing you acquired by pledging that future time can be taken away.
The house gets foreclosed, the car gets repossessed, the system enforces the time commitment.
Okay, now let's pivot completely. Let's look at the other side, the mechanism of reclaimed time, the position of the lenders, the creditors. They operate on a totally inverted principle.
Totally inverted. They are trading their present capital, which is their own previously accumulated stored labor that they chose not to spend on consumption.
Okay, so work they've already done and saved.
They trade that for claims on the future time commitments of others.
So they deploy their finished work, their stored time, and in return, they receive a stream of future time commitments flowing back to them from the debtor class.
Precisely. The capital they put out represents work already completed and stored. They essentially allow others, the debtors, to use those stored hours now. And the crucial mechanism, the engine that generates their own time autonomy, is the interest or the yield they receive.
Okay, explain that. How does interest or cash flow from an asset function specifically as reclaimed time in this framework?
The interest payment or the rent check or the dividend, that flow of money coming back to the lender-creditor is, in effect, time they have reclaimed from the world.
How so?
Because it's income they receive without having to actively trade their current time for it. They don't need to be physically present, exerting labor, focusing their cognitive energy right now to earn that specific dollar.
It comes in because someone else, the debtor, is currently committing their future labor to generate the money to make that payment, plus the extra bit, the interest or profit, for the privilege of having used the lender's stored time earlier.
Exactly. The lender is essentially acquiring extra hours, extra slices of life that they personally did not have to work for in the present moment. It sounds abstract, maybe, but the power is immense.
It decouples their income from their immediate labor.
Fundamentally, this income arrives whether the lender is actively working on something else, sleeping, traveling, reading a book, pursuing hobbies, whatever they choose. It separates their income generation from their physical presence and their active time commitment. A debtor's income is almost always tied directly to their physical presence and effort. A lender-creditor's income aims to be autonomous from their presence.
Okay, I need to challenge this again, though. Because becoming a successful lender or creditor, that surely requires work, too, right? It's not purely passive. If you're managing a bond portfolio or underwriting private loans or owning rental properties, that takes time. Due diligence, risk assessment, managing tenants, dealing with problems. Doesn't that mean the lender is still trading their time, just maybe in a different, more sophisticated way?
That is an excellent and absolutely crucial point for getting past a simplistic view. Yes, setting up these systems, deploying the initial capital, monitoring the investments, that does require time and effort. It requires using some of your stored labor to analyze risk and manage the process. No question.
So it's not entirely free time?
Not entirely free in the sense of zero effort ever. However, the critical difference lies in two things: scale and leverage. Host Speaker Banswar. Okay, explain the leverage part in terms of time. The lender-creditor, ideally, is trading a relatively small fraction of their own time. Maybe it's an hour a week reviewing statements, or a few hours a month overseeing a property manager.
Okay.
To generate an inflow of cash, an inflow of reclaimed time that might be equivalent to what would have required 40 hours of their direct active labor if they were earning it through a traditional job.
I see. They're leveraging their initial stored labor, their capital, to acquire multiples of future time commitments from others or from assets. Their input time is drastically lower than the output time they receive back.
Exactly. They shift from trading time linearly 1 hour of work gets 1 hour's worth of pay to potentially trading time exponentially, or at least with significant leverage. A small input of management time controls a much larger flow of reclaimed time.
This is the huge realization here. The fundamental conflict in finance, maybe even in society, isn't really about abstract political ideas or complex financial instruments in themselves. It boils down to the control and flow of human time.
Yeah.
Who controls the future commitments of labor?
That realization should fundamentally alter how you view every single financial decision. The lens shifts. You stop asking just, is this a good investment? Will it make money?
And you start asking.
You start asking the more critical existential question. Does this decision commit my future time to someone else's control? Or does it deploy my past time, my capital, to start reclaiming my future time?
The stakes are incredibly high, literally years of your life, which makes the ultimate goal very, very clear. The focus has to shift away from just piling up a big number
towards securing that autonomy. Yeah. And the mechanism for that is cash flow. So the standard way of thinking, the consensus driven by those first-level beliefs we talked about, it defines wealth almost exclusively by net worth. How big is your pile? We really need to challenge why this obsession with just accumulating the biggest number is, well, an incomplete and often quite misleading way to measure actual freedom.
Why is net worth alone insufficient? I mean, if someone has a net worth of $10 million, surely they're wealthy, surely they're free.
They are certainly wealthy on paper, no doubt. Sure. But net worth itself is often static. Yep. It's often illiquid. It doesn't necessarily translate into freedom today until you actually sell something, until you liquidate it.
Okay.
Think about it. You could have a $10 million portfolio, but if it's all tied up in, say, highly appreciated tech stocks that pay almost no dividends.
Right.
Or maybe it's a $10 million piece of undeveloped land. It looks great on the balance sheet, but it costs you property taxes, maybe maintenance, and it generates zero income right now.
So even with that big number, you might still have to work your day job just to cover your monthly bills, your living expenses.
Absolutely. The number might be impressive. It might validate all the years you spent saving and sacrificing, but the practical day-to-day freedom you get from it could be minimal until you start selling off pieces of that accumulated capital, selling off your stored labor.
Which then reduces the very net worth number you were focused on building.
Exactly. Yeah. You're still effectively trading hours for dollars, or trading past stored hours by selling assets for present dollars, even with a theoretically huge net worth. Your financial security feels constantly tied to the market's mood swings, the fluctuating value of that portfolio. If you need cash, you're forced to sell, potentially at a bad time. Without reliable cash flow, net worth can sometimes feel more like a source of anxiety or a maintenance burden than a source of genuine autonomy.
Okay. This leads us straight into what feels like the real aha moment in the source material, the clear operational definition of financial freedom. And it's based on a metric that seems to directly measure time autonomy.
Yes. Financial freedom, viewed through this second-level lens, isn't about hitting some arbitrary net worth target. It's defined as that specific, quantifiable moment in time when your monthly cash flow, coming from your assets, from your deployed stored labor working for you, equals, or ideally, clearly exceeds your total monthly living expenses.
That feels very practical, tangible, measurable. It's the moment you're emancipated from the need to trade your time for money.
The calculation the source uses is deliberately straightforward.
Yeah.
Let's take their example. Your assets, maybe rental properties, dividend stocks, private loans you've made, reliably generate $10,000 every month.
Okay.
And your average monthly expenses, everything included, are $3,000. That $7,000 gap, that surplus, that is freedom. Real immediate freedom.
The space between the incoming cash flow and the outgoing costs is the freedom itself. Okay, let me push back again here, though. We talked about net worth often being tied to safer, more liquid assets like diversified stocks. Cash flow, especially from things like direct real estate or private lending, can often mean less liquidity and potentially more active management, right? What if managing the assets needed to generate that $10,000 a month in cash flow, dealing with tenants, repairs, collecting payments, bookkeeping, actually ends up taking more of my personal time and energy than just passively holding a $2 million index fund portfolio? Isn't that trading one kind of time commitment for another?
That's the essential counterargument, absolutely.
Yeah.
And it forces us to make a vital distinction between active cash flow generation, where you're essentially buying yourself another job, and truly autonomous cash flow generation.
Okay.
The goal for the lender-creditor class, the ultimate goal, isn't necessarily to manage all the tasks personally. It's to deploy their stored capital, their money, to acquire or build systems that manage the assets and the time commitments for them.
Okay. So using the real estate example again. The goal isn't to be the landlord unclogging the toilet at 2 a.m.
No.
The goal is to have enough cash flow from the property to hire a professional property management company. They then commit their time, their labor to handle the tenants, the repairs, the collections.
Precisely. That $10,000 a month in gross cash flow is designed to be increasingly autonomous from your direct presence. If hiring that good property manager costs you, say, $1,000 a month,
Your net cash flow drops to $9,000.
correct. But your personal time input might drop to near zero, maybe just reviewing a monthly statement. You've successfully used a small fraction of your reclaimed time, the $1,000, to buy a massive amount of someone else's management time and expertise.
That's the key. You're buying back your time by paying others with the asset's own output.
That's when cash flow assets truly become engines of time autonomy. Net worth, in contrast, is more like a static snapshot. It represents potential energy, but it only yields kinetic energy, actual freedom upon liquidation or conversion into cash flow.
And this concept of cash flow freedom, you're saying it's fundamentally different from the traditional idea of retirement. Why is that distinction so important?
Retirement, the way it's usually talked about, is often tied to an age 65, 67, or reaching a large enough lump sum where you feel safe starting to draw down the principal, maybe following something like the 4% rule, hoping it lasts for your projected lifespan.
Right. It's about stopping work because you're supposed to or because the nest egg is deemed big enough.
Exactly. Cash flow freedom, however, isn't tied to age or a projected depletion schedule. It's about achieving the immediate ability to choose your work based purely on interest or passion or purpose, not economic obligation.
Meaning, the moment your asset cash flow reliably covers your expenses, you are free to stop trading your hours for dollars right then and there, regardless of whether you're 35 or 65.
You reclaim your time autonomy immediately. You get back what the source calls livable time on Earth, which, as we've established, is the ultimate scarce resource.
So, cash flow becomes the real-time dynamic measure of how successfully you've shifted your position, from being a time-committing debtor to becoming an autonomous, time-collecting lender-creditor.
It's money that arrives without demanding your continuous presence, your active labor, your ongoing time commitment.
So, okay, boiling it all down. The absolute conclusion of this framework seems to be the fundamental divide in finance is about time autonomy, and every single financial choice needs to be run through that filter.
Does this action commit my future labor further into obligation? Or does it deploy my stored labor in a way that starts reclaiming my future time? Cash flow is the mechanism that reclaims time directly. Net worth is important. It provides the scale, the capital base, but it often requires a much longer time horizon to build and then still needs to be managed or liquidated to provide true freedom. The priority, therefore, should be on strategies that accelerate autonomous cash flow generation, not just those that maximize the numerical net worth figure decades from now. So as we wrap up this deep dive, let's just quickly recap the two, I think, really critical shifts in perspective we've covered from this framework.
Okay. First, we really dug into how the standard financial advice, the consensus beliefs most people follow, those first-level conclusions, while maybe functional on the surface, are fundamentally incomplete.
Right. And that applying second-level thinking is absolutely essential. Asking who benefits helps us understand the systemic forces at play and why the rules often seem structured by the lender-creditors, perhaps unintentionally benefiting them more than the debtors following the script.
And second, and maybe most profoundly, we clarified that deep, almost existential link between money and time. Money is stored labor.
And therefore, true financial success isn't just about a big number. It's about strategically shifting your role, moving away from constantly trading your future time as a debtor towards actively deploying your stored capital to reclaim future time as a lender-creditor, primarily through generating autonomous cash flow.
That shift completely changes the goalpost, doesn't it? It moves the listener's core question away from just how do I make more money or how big can I get my portfolio?
To the much more vital question, how do I strategically reclaim my time and what concrete steps can I take starting now to stop selling off my future life?
That change in the central question, that feels like the key to unlocking real freedom.
And we established that cash flow, that measurable surplus of asset income over expenses, is the clearest, most direct metric for tracking that progress toward time autonomy.
Now, looking ahead, thinking about where this leads. The source material leaves us with a really interesting, almost unsettling historical question to ponder. We've sort of established this divide between debtors and lenders based on time control now. But how did the system get so powerful, so all-encompassing?
Yes, that's a crucial loose end. We need to ask, how did debt itself evolve? Historically, it was often just a local social agreement, right? Maybe lending a neighbor grain until the next harvest, a promise of labor between known individuals.
A social bond, almost.
Exactly. How did that transform into the massive, impersonal, global financial instrument it is today? An instrument that literally shapes entire lives, dictates economic policy, and underpins vast political structures.
That transformation, the journey of debt from a simple social promise to this incredibly powerful tool for leveraging and collateralizing future human time on a global scale, that seems like the missing piece of the puzzle.
Understanding how human time and labor became so effectively packaged, securitized, and traded globally is probably essential to fully grasping the true depth and implications of this time autonomy struggle in our modern world. That history deserves its own deep dive.
Agreed. It forces you to look at the history of finance not just as economics, but as the history of developing ever more sophisticated mechanisms for controlling and allocating finite human time.
Meticulously designed mechanisms, perhaps.
Well, thank you for going on this incredibly detailed exploration with us, unpacking the hidden cost of money. We genuinely hope this framework gives you, the listener, some powerful new tools to challenge your assumptions and maybe shift your focus from just chasing that distant number
towards actively reclaiming your most valuable, absolutely non-renewable resource, your own time, your life years.
Until next time.
Indeed. Until next time.
Thank you for listening to The Credit Edge. More frameworks on credit markets and income investing are available on Substack and YouTube. Perhaps I'm wrong, but the questions are worth asking. The Credit Edge is for educational purposes only, not investment advice.